Hello, everybody. Welcome back to Beer and Money. My name is Ryan Brooklow, and on today's episode, we're going to be talking about the presidential election and how it affects the stock market. And what's interesting about this is I think it feels like now more than ever, a lot of people are on pins and needles around who's going to get elected and how that's going to affect their money as well as other items. Today's conversation is more going to be around the investment piece, and there are deservedly so, some stresses around what's going on. And so today's conversation is going to be about really looking at over the history of presidents and parties specifically and how the market's done. So that's for today's episode. So without further ado, let's dive right in. So I got an email from a client that mentioned this theory that's out there. It's called presidential election theory. And what it is it says US stock markets perform relatively weaker in the first 2 years of a term, and then return spike or peak in the third year of the term before falling off because of various events in the fourth year. And this is, to cite some stats from this, there's a gentleman by the name of Lee Bowl. He was a researcher, and in 2016, he found that, now this is for the S&P 500, that on average in the first year of any presidential campaign or their first year in presidency, on average, it's a 6.7% rate of return. And then the second year is 3.3. So like back to that presidential election cycle theory, it does hold true from that standpoint, right? So the first 2 years of the term tend to be weaker. And then year three is 13.5% before going back down, albeit to 7.5%, which isn't horrible in the fourth year. And what I find interesting about the study, I'm not here to say that study is right or wrong. What I am here to say is that's looking at like 4-year periods of time, and there has been plenty of anomalies that would throw that average off. Just look at 2016 with President Trump and 2008 with President Obama, right? And so we have to really take a step back and look at the bigger picture. And by we, I mean all of us. What's really interesting about these studies is, they're looking at these 2 4-year periods of time. Well, we're not investing for 2 or 4 years periods of time. Like, at least I don't think you should be investing for that short of a period of time. Like, if you need money in that period of time, it shouldn't be in the stock market because the market can go up and down and we just don't know what's going to happen. But over the bigger picture, throughout life, right? Pre-retirement, we've got a, 10, 15, 20, 30, 40-year ramp of our money being steadily invested in the market. And then even in retirement, it's not like we get in retirement and we go all to cash, right? We still have some money in the stock market. So in its most simplistic form, we might have 100 years. I know that's overdoing it a little bit, but we have a long period of time in our life that our money is going to be in the market. And we should look at it from that standpoint. Now, there's strategies in place, but when we're talking about just investing alone, this is a conversation that you should be really having with your advisor or your team. And so what I want to bring up is, again, this isn't relation to specific presidents, although you see the presidents on the slide. This is in relation to the parties, Republican and Democrats. And what I want to show you here is, and for those of you who are listening into your car, you might want to check out the YouTube channel, because I think this screenshot is a good screenshot to look at to really get the full picture of what I'm sharing here. And so what you can see here is, right, you've got the Republicans in red and the Democrats in blue. And overall, if you look at this, right, it's just this curve that's going up. Now, there are some years where it's going down, obviously, but overall, over the long haul here, it's gone up, right? And so something to consider when we're investing, like let's just start in 1986 here, right? We've got Reagan and then Bush, and you can see little blips all along the way, but from Reagan to Bush, the market went up. Clinton comes in, again, had a great term, market went up. Bush comes in, it comes down, goes back up, and then goes back down. President Obama comes in, goes up, right? You can see it's a trajectory of going up. Now, it's got blips in there, but we need to be looking at the bigger picture. And so this is just a reminder around what it is you should be considering when the media heads start talking. Oh, it's going to be a down year because so-and-so is going to be president or this or that. look at the bigger picture and make sure, Alex and I have spoken in what seems to be a lot, but it's just a reminder. You need to make sure you've got liquidity and access to money, right? All of your money being in the stock market with nothing sitting on the sideline isn't necessarily a good thing, right? We've said it before, and it's not just the bad things we're talking about here. What about opportunities, right? The market goes down, but all of your money's in the market and there's an opportunity. Well, it's obviously not a great time to pull money out, right? So we need to have access to money. And so what to do, right? I get this is stressful, right? It's appealing to watch the media heads talk, right? But first things first, don't panic, right? Make sure you talk to your advisor, talk to your the business professionals around you around your money, and make sure that you are following through with your investment profile in terms of what risk you're taking on, and make sure you're on the same page with your advisor. Number two, make sure you're diversified, right? This has been all about S&P 500. We've had conversations before where the S&P 500 is not the stock market, right? It's going to go up and down, and you really shouldn't have all your money in one basket like the S&P 500. So make sure that we are diversified, okay? And then number three, make sure you have some semblance of a plan, right? And holistic plan, looking at the entire picture, not just stocks and bonds, but your entire balance sheet. How much money is in savings? How much is in investment accounts, retirement accounts? What risk profiles they have? What debts we have? What cash flow that is, right? And I know that's a lot to take on. I just spit it out like it's easy to think about. This is what your professional or the person that you've been talking to about money can help guide you with, and in turn, really kind of help remind you of the bigger picture. Yes, we're going to go through some down terms. It just is what it is. We're going to face several more in our life. But if you have a strategy and you've got a plan and diversification and someone you can talk to, it makes it a lot easier. So I just wanted to throw this out there today because, like I said, I got an email about that theory. So I wanted to present that. And if you guys have any questions, if you want to talk to Alex and myself around your personal financial situation, that's a great spot to go to is thebeardmoney.net. And to contact us at the top, there's a great way to reach out to us if we can help. Or if you have questions from this episode or other episodes, there's a great way to interact with us. Look, we started this episode or this podcast to help you think differently about your money so you can spend time with your family and not stress over the money and be confident. I hope this episode was valuable for you. And as always, cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklow, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806. Number 721-6226.1, expiration October 2026.